Welcome back to the IB Investor channel. In this video, we'll cover the Swedish serial acquirer Addtech. We'll cover a short introduction of the company, the share price development, the sales and profitability, the cash flows, the debt situation, the dividend, and the CEO remark. Now, this company has its roots from 1906 from the company Bergman and Beving. However, in 2001, they spun off this company Addtech along with some other companies. The company has a 45.5 billion Swedish kroners market cap. It's currently trading at the Swedish large cap market. The ticker symbol is ADDT. It works within the industry industrial components. Now for the share price development, and we can see here since its listing in 2001, the share price has appreciated very well over this period. However, we can see that there has been some dips over the years. So in the most recent financial crisis here, the stock went down. We've seen some declines here recently as well from the top levels here at 240. So the stock has been cyclical at times and going down with the market. So it's not been a perfect ride, so to speak. But here on the right side here, we can see the total returns as well, including the dividends here. So if you held the stock, for the 10-year period here and reinvested the dividends here, you made almost 620% return here. So very impressive numbers here. Even for the 5-year period here, you made 270% here if you reinvested the dividends. So very impressive numbers here. And if you held it for the long term here, ever since the inception here, investors has received a return of 4,700%, almost 4,800%. And this number does not include dividends. And during one period here, I don't remember exactly when, I think it was around this period here, they also spun off a company called Addlife that I might make a video about in the future. So they've actually spun off some companies during this period as well. And despite of that, the share price has done very well here. So very impressive share appreciation here for sure. Now for the income statement for this company, we can see here in the blue line here, the net sales has been growing pretty well with some off years, with some decline year over year. But other than that, we can see here that the improvements in net sales has been growing for the long run here. We can also see the EPS here growing pretty nicely with some off years here in decline here in 2001 or 2021 from 2020. We can see a small decline here, but ever since it's been growing, which is nice to see. This is precisely what investors and speculators likes to see for the long term here. We can also see the gross margins here, which are actually quite low, I would say, for an industry company. I'm not too excited about the number here at 30.8% gross margin here. They have been as high as 32% here in 2015, so we have to go far back, but still, 30% margins are not anything special. It's, if anything, it is quite low, so I would assume that this company has some potential on the upside to drive margins higher here, but it's up to management, to drive those margins, because 30% is not massive in my opinion. I think that, it should be possible to make higher margins here. Looking at the profit margin here, it's only at 8.2%. So this company isn't really printing any money on the bottom line. In terms of margins, we can see that the margins have been lower though in the past. So management has actually done a good job here increasing the margins here over time, which is good. So they had some levels here in 2017 where the margins were under pressure and went to 6.1% over this period. So comparing it to today's 8.2% profit margin is obviously better, but the margins aren't, super great. Now for the free cash flow margins here, we can see that it has been pretty volatile here in many periods here. We can also see that it's been negative, which is not something I like to see, and investors do prefer to have a positive free cash flow margin. But it is what it is. In the most recent quarter here, they did post a 7.1% free cash flow margin. And I think it can be good just to mention here. I didn't mention this previously, but this company does have a broken fiscal year. So their Q2 2024 report here, which is their most recent report, that's equivalent to most company's Q3 report for 2023. So if you wonder why they're already in 2024, well, it's because of this broken fiscal year. We can also see some peers here, so Indutrade at a very low 1.6% here, and Alfa Laval at 6.7% free cash flow margin here. So yeah. Now for the free cash flow per share in terms of kroners, we can see that the company did post a 5.2 kroners here per share, and it paints pretty much the same picture as we saw in the previous slide, so we're not going to dwell on this. But we can see currently that the company offers a 3.1% free cash flow yield, which isn't too great, but it's not bad either. Now for the share count history here, so we can see all the shares that they have now in millions, and we can see that they have been growing the shares, if anything, but it's it's growing at a very low level here. So it's growing at a 0.33% CAGR here from this period to this period over a 9-year period here. So nothing bad, I would say. The dilution is not massive, and it's barely seen here with your eyes. So nothing alarming, I would say. I've seen much worse. Now for the free cash flow overview here, and we can see the cash from operations here in blue growing pretty nicely here, which is what investors like to see. We had some decline here for some off years, but since it's the most recent quarter we're looking at, it looks pretty well. Looking for the capex or investing side of the business, we can see that they have ramped up the investing here, which is obviously not a good sign all times, but as long as the cash from operations is growing at a faster pace, I would say, comparing it to capex, then it looks pretty fine right now, and especially then since they are posting a very positive free cash flow here at 1.4 billion Swedish kroners, comparing it then to the investing at 1.1 billion here. So it looks pretty much okay for the cash flows, and especially here since they are growing the cash from operations. However, let's say that this number here, the 2.5 billion, would have been like 1 billion or something like this at the same time as the investing would have been 1.1 billion. It's one of those cases where it would have been alarming here, but this looks pretty fine to me, I would say. Now for the net debt versus the cash from operations, so starting here with the net debt in the blue line here, we can see that the net debt has been increasing, which is kind of alarming in itself. However, we can see that the cash from operations have been growing along as we saw in the previous picture here. So it's nothing alarming right now. And as we can see here for the most recent quarter, they would be able to pay off all of their net debt with less than 2 years right now, which is pretty good. However, when looking back here at 2022, this looks more worrisome, where we see that that the gap is increasing. So from this year, they increased the net debt from 3.1 billion Swedish kroners to 4 billion Swedish kroners here, whilst the cash from operations went from 1.5 billion down to 1.1 billion. So here we can see the gap increasing, and it's one of these cases where you don't want to see that. You want the gap to be declining like this. So for now it looks pretty good, but investors should pay attention to this going forward, so that the net debt isn't spiraling out of control whilst the cash from operations is declining. Now for the net debt to EBITDA here, we can see that the company currently has a 1.6 times multiple, which isn't too bad, and especially here going back, they've had higher multiples in the past. So a 1.6 multiple isn't so bad, especially not considering that the cash flows from operations are growing pretty nicely. However, it's always a luxury, to have a negative multiple here, but in this case they have some net debt, as we saw on the previous page here. We can also see here for some peers that Indutrade trades at a little bit higher multiple here at 1.7 times, and Alfa Laval here at 1.2 times. So nothing alarming right now. However, if this multiple were to go up massively in the coming quarters, then we should be alarmed. But right now it looks pretty okay, I would say. Nothing special right now. Now for some valuation metrics here, so we're looking at the enterprise value to EBIT multiple here. So the company currently trades at a 20.7 times multiple, which isn't cheap, I would say, but it's not expensive either. Like trading at roughly 20 is oftentimes in line with what this company has done historically speaking here when looking back. And comparing it then also to some peers here in the trade, and Alfa Laval that currently sits at similar, EBIT to EBIT multiples, I would say that this company is not, it's not overvalued per se. We've seen some overvaluation here for some past years here where the company traded at a valuation, in my opinion. So 40 times, that's quite a lot for this type of company. But a current 20 times multiple or 21 times multiple is, it's not cheap per se, but it's not expensive. So yeah. Now for the return on invested capital here to see how well management has allocated capital in the past. So this company has a pretty good track record, I would say, with being in the higher teens as an average here. So currently in the most recent quarter at 16.6% here, which is quite okay. Anything about 10% or so is pretty okay, I would say. And also comparing it here to Indutrade at 12.2% and Alfa Laval at 12.5%, just as a peer comparison here. But mostly here, historically speaking, it has been a little bit higher, as we've seen in the past. But a 16.6% return on invested capital is pretty respectable in itself, and nothing alarming, I would say, for this company. And during this period here, I would just assume again that maybe they sold some company or did something here to make this number go up so much. So yeah. Now for the dividend side of the business here. So here's the dividend per share in kroners, and we can see that they have had a pretty good track record here. Not too consistent, since the dividend has been going up here in the year 2020, but it did go down here in the year 2021 for the payout. So this is the annual year for 2020, and they paid out in the year after. So we have seen some declines, so it's not super, sustained in terms of steady growth, but rather over time, though, it has been growing pretty nicely. So, just comparing this period here from 2019 to 2023, where it was paid out, it was a double basically in dividends. So that's very, very strong, considering it's only 4 years difference here. So very strong growth here, and we can see that the company is currently trading at a 1.5% dividend yield, which is, it's not cheap by any means, but as we see here as well, the dividend growth has been pretty massive, I would say, here at almost 39%, almost 40% dividend growth from one year to the other. So very strong dividend increase here from the board. So if anything, this puts investors to where the board here has a lot of confidence here on the balance sheet. So this is a pretty good dividend grower, I would say, right now. Now for the CEO remark here, and I chose not to include all of it. I just figured it was good to include what I thought was important here. So he's basically saying here, the CEO, that the market is pretty stable in most geographies right now. The only thing he's really seeing some issues with, or one of the things, is the sawmill industry here that apparently are at low levels right now. But then again, he's seeing that some markets, for example in Benelux and DACH, are pretty strong. Also Norway is pretty strong, pretty stable, he's saying, here in Denmark and Sweden. However, he has seen some decline in Finland. So all in all, it's pretty good. And he's also saying here that he's not seeing any decline in customer activity right now and under the quarter. However, the total order book has decreased some in volume, which reflects the gradual normalization of the customers ordering. But that's also the case, when we look back here for the COVID period, there was a lot of issues, to deliver things because, the lead times were so long. So that could, in a sense, be the case that maybe now the customers don't order it in much in advance, because they know now that companies have the capability of delivering at much faster rate now compared to back in the days during the COVID years. So I think that what he's saying here, what we've seen with many other companies as well, is that some order books are going down from like 5 to 2 months, but that doesn't mean that they have less to do. It's just that the order book has declined but the orders are still coming in, but with much shorter lead time. So I think that's what he's saying here as well, that you know, the order books are still being fulfilled, so to speak. So yeah, I mean, nothing really here to worry about. It looks like it's a pretty stable quarter. And he's also saying here that they have some focus here on the long-term goal here, which is always to create long-term stability and profitability according to their, you know, goals to double the result here every 5th year. And this company has certainly done so in the past. So he's confident in the business, and that's the plan going forwards at least. And as a quick reminder again for watching this video, do remember that Addtech has a broken fiscal year, so their most recent quarter here is Q2 2024, which could be quite confusing in this video when you watch my slides here or pictures here for some of the KPIs here. So please bear that in mind when watching this video. Anyways, thank you for watching. If you liked the video, please hit the like button and subscribe for more content. Thank you very much for watching. Bye.